best investment by far is anything that develops yourself.
What is the secret options trading strategy Warren Buffett and many hedge funds use? And how can you apply this to your personal situation, your personal investing goals for a consistent income generation of between $10,000 and $20,000 plus per month, consistently at very low risk? Now, this is not something I often say, especially in the investing game, but this is a verified hedge fund strategy that you can apply personally. Of course, it's not for everybody, and I'm going to dive into exactly who it's for and the type of people who can do this strategy. Now, for those who are new around here, I'm Ben, and welcome to Hedge Alpha AI, formerly Motivation to Invest. With that being said, let's dive in. Ben, does Warren Buffett actually use options? He says he's a traditional value investor. He just buys companies below the intrinsic value and holds them forever. Now, that is correct, but he also uses options more as a way to identify a stock, identify the value of the stock, and then get paid while he waits to buy the stock. And this is exactly what this strategy does, which I'm going to reveal to you in this video.
Case. We bought and sold options. As a matter of fact, on June 3rd, Berkshire Hathaway will receive $60 million if the S&P 500 closes at 1150 something or below.
Berkshire Hathaway has publicly disclosed selling put options in regulatory filings. They also documented this extensively in the 2008 to 2010 shareholder letters, but most people weren't paying attention. Now, Berkshire Hathaway actually received billions of dollars in upfront premiums using the same underlying principle, which I'm going to teach you in this video. Of course, I'm just going to show you the basic overview, not the full deep dive. So again, who is this strategy for? Of course, there is a catch. You do need meaningful capital. So you cannot do this strategy with $1,000 or $10,000 or $2,000. You can start it, but you won't really generate any significant income to actually live and actually have a reasonable life for the amount of time that you put into it. So I generally recommend at least $50,000 to $100,000 plus. Ideally, you want to be around the $200,000 to $300,000 mark. Now, some of you may say, oh, Ben, that seems like a lot. Well, it does, but if you were going to put that into a property and only get 6% per year, in this strategy you can get 4% per month, then it's actually not that much. The people I find this strategy resonates with are value investors because they understand the concept of buying quality companies at a discount. Also income seekers, so dividend investors who understand the idea of buying a stock and generating passive income without excessive risk. So it's really for patient, disciplined people. In the not suitable for list, I've put day traders, although again, you might want to understand this strategy for interest. Meme stock people looking for a 20x in a day, get rich quick. A few more details here. So those people who are looking for a passive income, part of the FIRE community, financially independent, retire early. People have a FIRE number, for example, and they want to reach this number so then they can live off that amount of capital consistently. This is kind of the people who this strategy is perfect for. What is the income problem with traditional investing? So you may say cash is king, capital is king. When I get this amount of capital, I can do this, this, and this. But really, if you look at most asset classes, they offer very low returns. So dividend yields 2 to 4%. You do get some dividends offer 7%, 8%. Real estate, now if you do a really good real estate investment, for example, I live in Dubai currently, great place for real estate, great place for real estate investments. But still, even here with 0% tax, you're still going to earn around 6 to 7% interest. Now, I would say the strategy is somewhere in the middle. So it's less risky than growth stock investing, but it's much higher returns than these asset classes stated here. Let's take a step back. I know there's a lot of beginners here. What are options? I remember when I first heard about options, it was a little bit confusing. It took me a minute. I want to help you guys to understand. So options are basically just contracts. So they're agreements between two parties, a buyer and a seller, to sell assets at specific prices in the future. Call options allow you to buy shares at that specific time or at that specific strike price. Put options allow selling of the shares at that specific time or strike price. Okay, so here's an example of a call option. So a call option might involve buying the right but not the obligation to buy 100 shares of stock in, let's say, techcorp.com, wherever that is, at a set strike price. For example, if it was trading $50 per share, and let's say an expiration date, let's say it expired next month. Now, you'll be paying a premium, so you might pay $2 per share, $200. Now, if the stock rises to 60, you may profit $3 per share. So you take what you paid, you minus the difference and the premium, and so you make $300, for example, on that one, which is a fantastic return on a $200 investment. But in this case, and with this particular strategy I'm going to reveal to you guys, is we're not buying call options, we're selling put options. Now that is the difference. People are buying with an expectation the stock will increase. We are selling put options. So we're basically selling people insurance that the stock might drop. We are selling them that insurance, and we are collecting premiums for the pleasure of doing that. So company ABC, this could be Microsoft, this could be Apple, this could be any stock. Let's say it's trading at $100 per share. And we believe, based on historic volatility of that stock, the consistency of it, the technicals, that it will unlikely drop to $95 over the next month, let's say. We think it will say $100 or it will go higher. What we can do as an income generation strategy is sell a put option with a strike price of $95. And we collect a premium, for example, $3 per share, $300. As we said, initial stock price is $100. Our strike price is $95. The stock finishes above 95, we win. We keep the $300 premium. The stock finishes below 95, we don't necessarily lose. It just means we have to then buy the stock at the $94 price per share. And you might have been thinking about buying the stock anyway. So this is what Buffett does. Okay, so here is another example. We're going to look at Chevron and, of course, Mr. Buffett. Now, I'm not saying Buffett used this exact strategy to buy Chevron, but he has used a similar strategy to buy other stocks. Let's say Chevron is trading at $150 per share, which it is at the time of making this video. Now, you'd like to own it at $149 per share, or you could go as low as you like. Let's say you've done a valuation on the stock and you'd like to own it lower if you had to buy it. Now, we do know Buffett purchased more of this stock in Q2 of 2025 for $129 per share. So that shows us, let's say, the intrinsic value, or 20 to 30% below the intrinsic value, because Buffett looks for a margin of safety. $149 put option, that is our strike price. Now, there's various different strike prices. I can show you those really quickly on an options chain. So this is how options data looks. In your broker platform, it will look much more clean, I will say, but here's just an example. As we mentioned, Chevron is trading at 150 here. Sell a put option at 149, 148, and we can go further down. Now, of course, the lower you go, the less chance the stock will drop to that level and the less premium you'll make. So the higher here, 149, it's close to in the money. So you'd make a fairly high premium at that level. So this is the example we're using. Of course, you're taking a little bit more risk. You might have to buy the stock. We sell the put. We make $130 per contract. Each options contract is worth 100 shares. Ben, all this complexity for $130, that doesn't sound like much. Okay, I understand that. Let me explain to you why this is actually a lot. You make $130. Remember, you didn't have to invest anything at this point in time. The cost is, I would say, zero, but you have to have in your broker account $15,000 in the eventuality that if the stock goes below your strike, you have to buy the stock. So you have to buy 100 shares of the stock, $150 per share, $15,000. So you need that $15,000 in your account. Hence why we said the minimal capital requirement. We collect our $130, and what is the return on that? So if you do $130 divided by 15,000, that's actually, and let's say you do weekly contracts, 0.86% per week. Now again, doesn't sound like a lot. Times that by 4, 3.44% per month. Again, is that a lot? Times it by 12, 41% per year you will make on this example contract I've showed you here. 41%. To put that into perspective again, S&P 500 annual return over the past 50 years, 9.5% approximately. Per year, this is 41%. So we've beat the S&P 500.
You're completely sure of the math.
Look at him. That's my quant.
Your what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face.
That's pretty racist.
Look at his eyes. I'll give you a hint. His name's Yang. He won a national math competition in China.
Warren Buffett, the greatest investor of all time, earns 20% per year. So in this case, we beat Warren Buffett. Now, the reason for that is, of course, we're using a low amount of capital relative to himself. So even Buffett, when he's doing this strategy, he cannot do this with $10 billion and $20 billion because he'll impact the market and change the prices. So although there are a lot of hedge funds doing this, they do variations of this type of strategy in high frequency trading, etc. But really this is best for people between $100,000 up to 1.2 million. That's I would say the sweet spot for this strategy. When you're doing it with 50 billion, you're then moving the contracts, etc., the prices, premiums. Again, we wait for expiry, and here's the two possible outcomes again. So the stock stays above the 149 strike by next week or next month. You keep the $130. That's it. Simple. Okay, so if the stock falls below 149, it's not exactly bad. This is why I said heads you win, tails you don't really lose. It just means, okay, you now have to buy this stock at $149 below the price when you initially sold the contract. Now, if you believe the stock is undervalued, hence you're buying a stock you wanted anyway at a discount. How much can you actually make using this strategy? Here's some examples with real capital. So $100,000. Again, this is not invested, it's just held in your account. Conservative income, 2K to 4K per month. Not that exciting, although you can earn more. $250K per month starts getting a little bit more interesting. You can earn around 10K to 12K US dollars per month. $500,000 and even $400,000, $300,000 are good figures also. You can earn between 10K, 20K, even 25K per month. Now keep in mind, if someone put that 500K into a property, they'll only earn 6% per year. And so, for example, let's say even a 250K property, even in Dubai, 250K property, you might get, if you're lucky, you'll get around $1,500 per month you'll make. In this case, you're making $12,000. So you're making not 10x, but you're making 8 times what you'd make on a real estate investment. So how do we actually do this? What's our metrics that we look at? So one of the metrics is called delta. This is your risk dial. So if the delta is low, and you'll see the delta on a brokerage platform, that means there is a lower assignment risk. If the delta is high, it'll be higher income, but it's also higher risk of assignment, which means you have to buy the stock. Not that you lose money, you just have to buy the stock. So that's how it works. Now, of course, there is a sweet spot, and there's different rules, and there's a few other metrics. Now, what are the risks? The risk mainly is yourself. You need discipline. You need to follow the rule sets, the systems, the processes, construct your portfolio in the right way. It's not fully passive. Again, I mentioned I'd say 1 to 2 hours per week it would take. But why doesn't everyone do this? And isn't there a risk if everybody does it, the alpha will go? And of course, I've researched this before I made this video because I wouldn't want to reveal something that would ruin my own returns. Basically, all the research shows that even if more and more people did this, it wouldn't impact their returns because, again, there's a kind of a limit. How do I learn this more? How do I really dive into this? Now, to do this long term, you need a clear rule set verified by the hedge funds, the best hedge funds from around the world. You need risk management and edge cases, position sizing, portfolio management, and discipline across different market cycles. This is what you need. Now, as mentioned, those of you who are serious about this, you want some next steps, you actually want to take action on the opportunity here, I do offer a structured course and mentorship program for a few select people. So again, this is people who have a bit of capital and they want consistent income strategy. Now, this will teach you the cash secured put fundamentals. It will teach you the portfolio construction. It will teach you the risk management, the drawdown management, rolling assignment decisions, income forecasting, income trackers, but that's not all. For those of you who may think, well, this does sound a bit complex, I'm not sure if I have the time to learn all this, we also have developed a custom AI which will help you learn this strategy step by step. It's been uploaded with all our rule sets from different hedge funds. There is a Google form in the description. Check it out, sign up, apply, and we'll review the people who seem most genuine, most aligned to this philosophy, this Buffett income generation philosophy. And those people will reach out to you. If you want to see more, just let me know in the comments or any questions. And yeah, if you're new around here, feel free to join the community, Hedge Alpha AI. I won't be making too many videos. It's been great to do this one, and hope you guys have an incredible day. See you next time.